Imagine waking up on the first day of every month and seeing cash deposited into your account without clocking in for a shift, answering emails, or chasing clients. For many Americans, that sounds like a dream reserved for retirees or millionaires. But in 2026, building a dividend portfolio that generates consistent monthly income is more accessible than ever. The real surprise is that you don't necessarily need millions of dollars to create meaningful cash flow. With the right strategy, a carefully constructed $100,000 dividend portfolio can become a powerful income producing asset that works around the clock, whether you're sleeping, traveling, or focusing on other financial goals. Today, we're breaking down exactly how investors are building dividend portfolios designed for monthly income, what mistakes to avoid, and how to position yourself for long-term wealth creation in today's market. Let's start with the big picture. A dividend is a portion of a company's profits paid directly to shareholders. When you own dividend-paying stocks, you're not just hoping the stock price rises, you're also getting paid for owning the business. This creates a second source of return that many investors overlook. In an era where market volatility remains a constant concern, dividend income offers something extremely valuable: predictable cash flow. While no dividend is ever guaranteed, many established companies have decades-long histories of paying and increasing dividends, even during the economic downturns. That's why dividend investing continues to attract both retirees seeking income and younger investors looking to accelerate wealth accumulation. Now, let's talk about the $100,000 portfolio itself. One of the biggest misconceptions is that a portfolio needs to generate massive yields to be successful. In reality, chasing the highest dividend yields can often lead investors into risky territory. Some stocks advertise double-digit yields, but those payouts may be unsustainable. Instead, successful dividend investors often focus on a balance between yield, stability, and growth. If a portfolio generates an average yield of around 4% to 5%, a $100,000 investment could potentially produce approximately $4,000 to $5,000 annually in dividend income. That's roughly $333 to $417 per month before taxes, and importantly, those dividends can continue growing over time if the underlying companies increase their payouts. One of the most effective strategies in 2026 involves combining dividend growth stocks, high-quality REITs, and select income-focused ETFs. Dividend growth stocks are companies with strong earnings, healthy balance sheets, and long track records of increasing shareholder payments. These businesses may not always offer the highest initial yield, but they often provide something even more valuable: rising income year after year. Many investors appreciate the compounding effect that occurs when dividend increases outpace inflation. Over time, what starts as a modest income stream can become significantly larger without requiring additional capital. Real estate investment trusts, commonly known as REITs, have also become increasingly popular among income-focused investors. REITs own income-producing real estate and distribute a large portion of their earnings to shareholders. Because of IRS regulations, many REITs pay attractive dividends compared to traditional stocks. In 2026, sectors such as data centers, healthcare facilities, logistics warehouses, and residential housing continue to attract investor attention due to long-term demand trends. These assets generate rental income, which can help support consistent dividend payments even during periods of market uncertainty. Another important piece of the puzzle is the use of dividend-focused ETFs. Exchange-traded funds provide instant diversification and can reduce company-specific risk. Rather than relying heavily on a handful of individual stocks, investors can gain exposure to dozens or even hundreds of dividend-paying companies through a single investment vehicle. Many dividend ETFs are designed to prioritize companies with strong financial health, sustainable payout ratios, and histories of dividend growth. This approach can help smooth out portfolio performance while maintaining a reliable income stream. One challenge many investors face is creating monthly income when most companies pay dividends quarterly. The solution is surprisingly simple. Experienced dividend investors often structure portfolios so that different holdings pay dividends in different months. By strategically selecting stocks, REITs, and ETFs with staggered payment schedules, it's possible to receive income throughout the year rather than waiting for quarterly distributions. While the exact amount may vary from month to month, this strategy can create a much smoother cash flow experience, which is especially valuable for investors using dividends to supplement living expenses. Of course, taxes are another critical consideration. Dividends received in taxable brokerage accounts may be subject to federal taxes depending on whether they are qualified or ordinary dividends. That's why many investors evaluate whether dividend investments should be held inside tax-advantaged accounts such as a Roth IRA, traditional IRA, or even certain 401k plans. Understanding the tax treatment of dividend income can significantly improve after-tax returns. While tax strategies should always be discussed with a qualified professional, smart account placement remains one of the most overlooked ways to maximize long-term income. Perhaps the most powerful aspect of dividend investing is reinvestment. Investors who don't immediately need the income often choose to automatically reinvest dividends back into additional shares. This creates a compounding cycle where dividends purchase more shares, those shares generate additional dividends, and the process repeats over time. The result can be extraordinary. What starts as a $100,000 portfolio can gradually expand through market appreciation, dividend growth, and reinvestment. Over a decade or longer, the difference between spending dividends and reinvesting them can be substantial. However, successful dividend investing requires discipline. Markets will experience corrections. Headlines will create fear, interest rates will change, economic cycles will come and go. During these periods, investors often make the mistake of abandoning long-term strategies in pursuit of quick gains. Dividend investing rewards patience more than excitement. The goal is not to find the next viral stock or overnight winner. The goal is to own quality assets that consistently generate income and increase shareholder value over time.